Good afternoon, everyone, and welcome to today's webinar. My name is Samantha Brennan. I'll be the moderator for today. We're excited to have you guys join us for Unpacking Business Tax Returns, a forensic approach to corporate and partnership filings. This webinar will run for approximately 1 hour. If you have any questions, please drop them in the Q&A and we'll address them as time allows. Before we begin, I'm just going to introduce our speakers and go over a brief disclaimer. Our first speaker is David Gralnick, a partner here at KLG. David has worked extensively with closely held companies, attorneys, accountants, and financial professionals on business valuations, investigative accounting, enhanced earnings calculations, and damage claims. His background includes litigation consulting, forensic accounting, auditing, and taxation. Joining him today is Louis Panariello, also a partner here at KLG. Lou has an extensive experience in forensic accounting, business valuation, litigation consulting, and damage claims. His expertise spans matrimonial matters, estate and gift tax planning, shareholder disputes, corporate planning, business transactions, and financial asset tracing. He's also been court appointed as a neutral financial expert and testified as an expert witness. Our disclaimer, this presentation is for informational purposes only and does not provide legal, accounting, valuation, or tax advice. The views expressed do not necessarily reflect those of KLG Business Valuators and Forensic Accountants, LLC. Any examples provided are for illustrative purposes only, and materials from this presentation may not be distributed without KLG's express consent. With that, let's get started. I'll turn it over to David Liu now.
Thank you, Samantha, and welcome everybody to our continuing webinar series. We're going to, as you know, tax season is right around the corner. We're going to talk about business tax returns as the filing deadline is March 15th. So we're going to start with the two different types of business tax returns, one being the corporate tax return, of which there's two different kinds, the S corporation, which is filed as Form 1120S, and the C corporation, which is just Form 1120. And then we're also going to talk about partnerships / LLCs, which are filed utilizing Form 1065. Okay, so let's talk a little bit about the S corporation tax returns. So taxes, as most of you probably know by now, are paid on a personal level. The income or loss is reported on Schedule E of the personal 1040 tax return. The S corporation is considered a pass-through entity, meaning that the taxes essentially pass through to the personal owner or one of the owners, who would receive a K-1, and therefore it's passed through, and that's why it's reported on Schedule E of the 1040. Also, the new thing that we're going to talk a little bit about today is the PTET, or pass-through entity tax, which can be paid through your S corporation. So essentially, the S corporation pays a state tax on your behalf, and then you get to deduct that on the state tax return, and on your personal tax return on your Schedule A, you get to increase basically your state. Well, actually, that's not true, because you're lowering your income by utilizing the PTET. Therefore, you get almost like a tax break. So it kind of acts like the state tax deduction on Form 1040 Schedule A, but it's not, because of the new laws that they put into effect a number of years back at this point.
And you don't want it to be acting like the Schedule A deduction, because that's capped at $10,000.
Now it is, correct. So it's acting almost as the pre-capped number of it. In addition, S corporations, they can give you a distribution. There's no additional tax unless you go over your basis. So there are what they call basis limitations on the distribution. So if you are basically distributing more money than the income and the contributions you've put in over the time, less the distributions and losses you've taken, and that's really a simplified thing, then the distributions can become taxable to you. Moving on, a C corporation tax return is similar to an S corp, although the taxes are paid on the corporate level, not the personal level. Therefore, it's not considered a pass-through entity because the shareholder does not receive a Schedule K1. So another kind of a difference in what you can't, there's no PTET can be paid by the company, again, because it's not pass-through. But let's go back a step and say on the S corporation, you can have up to 150 owners or shareholders or however you want to call it. On a C corporation, that number is unlimited. So you can have 10,000. And that's why the public companies that we see are always are C corps, because they can have unlimited shareholders or owners.
And also with C corporations, they could have different classifications of stock. So a lot of times a startup company that wants to have, A shares for the controlling owners, B shares for those who are just investors, C shares for, maybe the next level of fundraising. They're usually C corporations because they can offer different classifications of stock, whereas as in an S corp, everyone is just a common stockholder.
And that also includes voting and non-voting shares.
Correct.
So that way, someone who has non-voting shares can't vote, but the people who have voting shares basically retain control or some sort of control over the business. In addition, and we see this a lot of time, a C corporation, they don't, instead of distributions, they have dividends, but those dividends are taxed to the individual and they're on a personal level. So they're called qualified dividends, usually 99% of the time they're qualified dividends. But that's why a lot of times you see on a C corporation, somebody's wages are significantly higher if they have one, because that way they don't have to pay a second tax on the dividends to get their money out of the company.
Right. And that concept is what's very commonly known as double taxation. If you look at Roman numeral 1, the corporation is paying taxes on the income. Then, if the stockholder takes a dividend on that same income, there's a second layer of taxes that are paid at the personal level. So layer 1 is corporate level taxes, layer 2 is personal level taxes, hence the name double taxation.
Okay, moving on.
Oh, so let me pull up. So rather than show you guys in the PowerPoint,
we're going to show you an actual 1120S, but redacted.
yes.
So that way you guys can't see all the private information. So this is an 1120S. This is page 1. We're utilizing the 2022 form. The 2024 forms are obviously out now. Actually, the 2023 forms are, no, 2024. I keep forgetting it's 2025. The 2024 forms are out now, but they don't change really over time. So they're very similar. So you can see in the large box there, you put your name, your address, the name of the company, the address, all that fun information. On the upper left-hand side, you see a little A, S Corp election date. That's the date that the company elected an S Corp. And if you go to E, the date of incorporation, here you can see it was like a 5-year difference. So between when they were incorporated and when they first elected S Corp status. So what we learned from this is you can be incorporated prior to becoming an S Corp. So originally they were probably a C Corp and then they became an S Corp. And there are certain rules that may or may not be associated with transferring it. That's really some complicated stuff. We're not going to get into that today. If you have questions about it, Lou is more than glad to answer those. Box B gives you the business activity code. That's basically telling you what type of business it is. So, when you're talking about, is it a personal services company or something like that? Is it a medical company? That's where you'll look to see what the code is. And if you look at box F, it gives you the total assets. In this case, it's $70+ million. If that number is $1 million or less, then there are certain forms that do not have to be filed. And we'll get into that as we get to those forms. So, then there are some other boxes. If there's a final return on H, a name change, if it's amended. Box I is important. It tells you how many shareholders there are. In this case, there are 7. So there should be 7 different K1s when we go to look at that. So then we talk about, the fun stuff, the income and the expenses. So the gross receipts, fairly obvious. That's the money they take in. That's their revenue. Okay, that's not their income. That's their revenue. Okay, then we have the cost of goods sold, which there's a separate form that we'll talk about later. So that's going to show the cost of the goods sold against that. And then you have what we call gross profit, which is your revenue less your cost of goods sold. So that's something that we look at very often, and it's important because the gross profit percentage, sometimes we see it go up and down when we're looking at the history of these things. So if that's the case, you're going to want to figure out why that kind of stuff happened. Moving on. So number 7, box 7, compensation of officers. And there's a form attached to this, which I believe we have in here.
It's in here.
So we'll be able to show you. So here it's 709,500, but that's not just necessarily for one officer. That's for all of the officers. And that number will eventually, when we talk about personal returns in about a month, we'll see that number will translate to the 1040 page 1 wages number. Okay, so when you're looking at that, you want to be able to match those 2 numbers. So that's an important thing, and it should also match the W-2. Then we have salaries and wages for the rest of the business. Okay, less certain employment credits. You have the employee retention credit that came out a few years back. That's kind of netted against that. And then we just have other normal expenses we see all the time: repairs and maintenance, rent, if there's interest on debt, taxes and licenses, depreciation, pension and profit sharing. Here you can see is a large number. So that's something that, as a forensic accountant, you're going to want to look into to see how much the owners are getting of that pension and profit, because essentially they're choosing to put it in instead of taking it out as income. Then it has the total deductions, the ordinary business income, about $300,000 here. And that's going to be divided in some percentage to the 7 shareholders. So if you own 50% of it, which I don't believe anybody did here, it would be about 150,000. And then you'll look to that. That'll be on the K1s, and we'll show you that as we go.
And as we go through a few of these pages, you'll see references to statement 1 and statement 2, and we're going to show you guys how to read the tax return in terms of these, upfront pages with the page 1, the P&L, the balance sheet, and then we'll show you, how to relate it to statement 1 and statement 2.
And then at the bottom, obviously the tax and payments don't apply here as an S corp. Because it flows through the personal. But if you look at the bottom, that has some information that, whoever signed it here was the president, but it also gives you the tax preparer's information. So, who that preparer is going to give you their name and their address, their telephone number. So if you need to contact somebody to get information, that's always a good place to start. So moving to the next page, page 2. So what's important here, Schedule B, if you look, check accounting method, cash, accrual, other. This one's marked accrual. We're going to talk about that later.
Yep.
We have a little session on that because it's important for you. We think it's important for everybody to understand the difference between what the cash and the accrual, which are the 2 main bases, and then we'll talk a little bit about some of the others. When we looked, if Luke could go back to page 1, there was that business activity code in B, the 523900. That applies to what's on page 2, which is it's a broker dealer and the product is brokerage. So you want to see if that makes sense. So sometimes we see, just ordinary, normal 999999 or 509999,
Right.
Because they just kind of put anything. If that's the case, it's not going to correspond. In this case, it does. So you could, but might want to look up those codes. You can do a search for NAICS codes.
Yeah, this year, this 523900, this is what's known as a NAICS code. That's the North American Industry Classification System, and it's publicly available information. And you could go onto the NAICS website and you can pop in 523900
And
and
see
just verify that it's corresponding with the business activity that's set forth on page 2 here.
Right, and that took over from the SIC code, which was a number of years back, which is what we used to use.
Yeah, and now the new classification system that's out there is the GICS code, and that's a little bit more broad, and it actually goes the codification goes right along with sort of the S&P 500 industry classifications, technology, financial services. So it makes comparing the subject company to publicly traded companies when we're doing our valuations a little bit easier for us.
All right, so the rest of page 2 doesn't really have too much importance. You know, you can read some of these, like number 3 has some importance. Was any shareholder a disregarded entity, a trust, an estate, a nominee? If if you're checking yes, then you have to attach Schedule B1. At the end of the year, did the corporation own 20% or more of another company, or 50% of the stock issued of another company? Those are things that we see sometimes. But if you see that information that they own a piece of another company, then you're going to want to ask maybe for those tax returns, depending on what percentage they own. If they own a large percent, obviously you're going to want to get that. If they own a very small percentage, then they're probably not going to be able to get them anyway. But you can utilize that. We'll look at Schedule D, which is the balance sheet, and that'll have some of that information on it, where we'll show you where you can look for that. And then at the end, there are some things about restricted stock and warrants, things like that you don't often see on S corps. So we're going to go to page 3. Again, there's some more questions at the top. During the tax year, was a qualified S election terminated or revoked? Things you don't really see often. And then you have Schedule K, which is essentially a reconciliation of what the income is on a K1 versus what it shows on page 1 of the tax return.
Right, and now here, this Schedule K, this is for all of the shareholders. So what you're seeing on Schedule K here are aggregate numbers. So if there's 4 shareholders, it's shareholder 1 plus 2 plus 3 plus 4. If you remember on page 1, the ordinary business income for the entire company was $296,277. So what this is showing is sort of how each of the pass-through items are going to aggregate for the entire company. And then the Schedule K1s are going to parse it out to each individual shareholder based on their ownership percentage or based on what's set forth in the operating agreement, whichever takes precedent. So the rest of the items on Schedule K, other than ordinary business income, are interest income and dividends, and those get reported on a personal tax return exactly where those items typically are reported. So interest income and dividends, if you have a Merrill Lynch or a Fidelity account and you're getting interest and dividends through those accounts, you're going to report those on Schedule B on your personal tax return. Same thing here. If you have pass-through interest and pass-through dividends, that also gets reported on Schedule B.
Right, and then here we have charitable contributions, 812,000. It's something you want to look into and figure out, is it accurate? Is it, are these people just overly generous? Is it part of their business that they need to do that? Sometimes we see that. So those are things that, you're going to want to look at. Moving on, Schedule K, just that's the final reconciliation of it. So if you take the 277 less the charitable contributions, you get the minus 516. I think I said it was Schedule D, it's Schedule L. I apologize. That's the balance sheet. So we're going to go through this. You have a beginning of tax year, which is going to be January 1st in this case, because it's a calendar year, not a fiscal year. And let's go back actually to page 1 and just show you guys that, because I don't think we talked about that. up top here, if this is blank, that means it's a calendar year. But if it says for calendar year 2022 or tax year beginning, let's say it said September 1st, 2021, ending August 31st, 2022, you would use this form. But you would have, that's a fiscal year. Okay, so when going back here, it would be the beginning of the tax year would be the beginning of that fiscal year. In that case, it would have been September 1st.
Right.
In this case, it's January 1st because it's a calendar year. But that's something you might want to look at too, because if it's a fiscal year, the compensation of officers is not going to match what's on a 1040 as well, because it's a timing issue. So it might, if they paid consistently into the next year, but it might not as well. So it's just something to keep in the back of your minds. Cash, you can see went down by $700,000 in this case. Current assets went down by 12,000. There's a statement. We're going to 12 million. Sorry. We're going to show you that. Statement 6, other investments. Remember when we talked about if you had interest in a business, that's most likely where it's going to show in other investments. They don't have one here. That's not what's going to be on statement 6, but you'll see it. Then you have, your fixed assets. If there's any intangible assets down at 13, and then your other assets, line 14, and then the total assets line 15, that's the totality of the assets that they have. So it was 83 million. It went to 70 million. They only lost $516,000. So I guess the question is, what did they do with those assets, right? And that's going to be a question. But if you look at the liabilities, okay, statement 8, they paid off $6 million of liabilities. So that's going to be where part of the chunk of it went. There's loan from shareholders. You're going to want to find out when there's multiple shareholders who those loans are from. There's a small little, long-term mortgage. And then you have other long-term liabilities. Again, this went down 6 million. So we talked about how the assets went down just about 12 plus, a little over $12 million. Well, the liabilities went down by a similar number. So when you take those numbers plus the loss, it kind of makes sense. And if you look, the retained earnings really only dropped by about $500,000, which is a loss. So that makes sense. And the total, one of the things we learn in accounting, assets equal liabilities plus shareholders' equity. Okay. So if you look, line 15, total assets at the end of the year, 70,484,633 matches line 27, which is the total of the liabilities and the shareholders' equity. So those two should always match. Believe it or not, we often see where they do not. Drives us crazy because we're like, how can an accountant do that? But we do see it, and then we have to try and reconcile those things.
And before we move on, if you look down at lines 22 and 24, 22 is showing capital stock of 400,000, and line 24 is showing retained earnings of 11.4 million. So in the aggregate, that's 11.8 million. When we're doing our evaluations, we have several approaches. We have many different methods, and one of those approaches is the cost approach and what's known as the net asset value method. And that's utilizing the balance sheet of the company. And in this case, the balance sheet of the company is reflecting an equity value of $11.8 million. So before we even get into discount rates and capitalizing income, we can look at this and say, this company, just purely its assets less its liabilities, has a floor value of $11.8 million.
There might be adjustments to that, like the shareholder loan,
right?
Or your depreciation. You may have to normalize depreciation, but for the most part, Lou's 100% correct, and brings up a good point. The floor value should be somewhere in that range. Here we have $2 million is loaned to shareholders, so it's actually going to be higher than that, but possibly assuming that they're all in, if the shareholder loans are all in equal numbers. Or, if it's just our person and we're going to add those back.
That's right.
All right. So here you can see Schedule M1. It was not filled out. Normally what it would be is line one would be the net income, which I think was 270 something thousand.
Mhm.
You would have a minus of 800 and something thousand for those charitable contributions. And then at the end of the day, income for Schedule K would have been a loss of 500 and change. If you know, that's what we saw on Schedule K. I don't know why it's not filled out here. I can't comment for other accounts.
In its essence, Schedule M1 is very useful when we're looking at the books and records of the company. So think QuickBooks is really the most commonly occurring bookkeeping system. And it's very common to have net income on QuickBooks that doesn't agree to the tax return. So Schedule M1 is a roadmap that says, okay, here's what was deducted on the books, and that's number one, net income per books. And then here's all the other adjustments that were made for tax purposes. And that's ultimately how you get to number 8, which is on the bottom right here. And that's what's going to reconcile to Schedule K, which is the totality of the business's income that gets passed along to all of the shareholders.
Right. Just some examples of what might be a difference. You can have different book to tax depreciations, meals and entertainment. Sometimes you see the 50% in there. Tax exempt interest, that would not be a taxable event, but it would be a Schedule K1 income. So those are some types of things you may see in Schedule M1. Schedule M2, which is everybody's favorite, this is basically taking your beginning of year. Remember Lou talked about the capital stock plus the retained earnings. Okay, this is just the retained earnings portion of it. The capital stock is separate. So the balance at the beginning of the year was 11.9 million. You had $296,000 of ordinary income. Then there were other reductions. We'll look at that Schedule 11, but we know what it is. It's the $800,000 of charitable contributions. Okay. However, what might, in this case, there are no contributions and there are no distributions. But those things, if they were there, would affect your retained earnings. So if they decided, because they had a decent amount of cash in here, to distribute $1 million, say, you'd put $1 million in here and this would go down to 10,471,000. They did not distribute anything here, so that's not the case, but that's an example, and this is one of the places you can look to figure out if there are distributions other than on a K1. Okay.
Okay,
Guys,
so
can I just
Dave,
jump in? Oh, sorry.
go ahead.
We just have two questions.
Okay, shoot.
So we're going back a few to, if you just scroll up. Yes, there, to the balance sheet. Were the charitable contributions made in the corporate name in order to be deductible or corporate return?
It's got to be in the corporate name, otherwise it wouldn't show up on the corporate tax return.
Okay. And does the C Corp deduct the dividends paid on the C Corp return?
No, so dividends that are paid by a C corporation are not a business expense. The dividends are paid out of the resulting income. So just as a illustrative example, this is not a C corp, but if it was a C corp and there was ordinary business income of $296,000, the dividends come out of that number. They're not included in the top portion here in your operating expenses, which get you down to the ordinary business income. So that's a really good question. It's not a proper business expense, so they're not deducted.
And just so you know, if they had a lot of cash or a lot of basis, they could actually distribute more than what was just the income in this year. So I know Lou said the 296, but it could be a higher number, it could be a lower number, it could be exactly that number. That's kind of up to what they want to do. And again, that's a taxable event on the personal tax return.
Got it. And we have one more. Are the
Okay.
distributions on the M2 tax-free to the recipient?
In it, well, again, so that we talked a little bit about that. So normally in an S corp, yes, in a C corp, no. Okay. But again, I say normally because there are those rare occasions that we see that they don't have enough basis to take the distribution. And if that's the case, then they can become taxable. Okay.
Okay, so if you remember on page 1 of the tax return, Dave showed you where there was a line item for cost of goods sold, and the total was $7,745,091. So there is a subschedule, this Form 1125A, that is disclosed, which gives you the detail for the cost of goods sold. This one that we're looking at is a very simplistic example, but when you get into manufacturing companies and construction companies, it's very typical to see line one, which is inventory at the beginning of the year, purchases, which shows what material was purchased throughout the year, cost of labor, that's going to be your 1099 employees. And then your line seven, your ending inventory. So that's what you started with and what you purchased, what's left at the end of the year. Now, why is this schedule so important to us? When you look at the gross profit of, a lot of companies that we work on, the gross profit could be 50%, 60%, 70%. And that means that 30 to 50% of the expenses or the deductions are going to be found in this schedule alone, right? So purchases is very commonly one of the largest expenses on a business tax return, which makes it very conducive for hiding personal expenses and perquisites, right? So we always make sure that we zone in on the purchases category when we're looking at the general ledgers, and we want to know what comprises that number on the tax return. Line three, cost of labor, very easy to tie out. You should get 1099s, and when you add those up, they should agree to what's deducted on cost of labor. What's a really interesting concept here is inventory, and that's where sometimes a business owner could play with their income a little bit. So what we do is we ask, how is inventory tracked within the business? We ask if it's a perpetual inventory system. That means it's in real time, constantly being updated. If something is sold, inventory goes down. They go make a purchase, inventory goes up. It's perpetual, it's a rolling basis. Or is it an end of the year count? Do they now go into their warehouse and pull their items off the shelf and do a count and then multiply it by the cost and come up with a solid inventory number that way? What we don't like to hear is when they say, well, it's an estimate. We looked at the shelves and we came up with our best guess, because inventory can really affect the bottom line income of a business. And they have the end of year inventory has an inverse relationship with income. So if you overstate your inventory at the end of the year, you can understate your income. And conversely, if you understate your income, if you understate your ending inventory, you can overstate your net income.
Right. It's one of those things that's very easy to manipulate on a tax return. So
Yes.
we do look at that. And going back to the purchases, a lot of times, in bigger companies, people use their credit cards for purchases.
Mhm.
So there's just, large payments on Amex. So, we tend to look at the Amexes when they're in purchases and things like that to make sure personal items are not going through that.
Exactly.
All right. And also box 9, kind of important, what method they use for valuing inventory, cost, which is what they paid for it, lower of cost or market, which is pretty self-explanatory, lower of the cost or what they could sell it for, or there's always another. And then, the other things, not really, LIFO method, last in, first out, not really things you guys need to worry about at this point.
Okay, so another subschedule. So again, going back to page 1 that David showed you before, there was also a subschedule, there was a line item for compensation of officers. And this form 1125E is what's going to show you the breakout of the compensation of officers. Now, it's very common that there's just one shareholder, one officer. They own 100% of the business, and whatever that line is on page 1 is reflective of the entirety of what that person's compensation is. In this case, you can see there are 3 officers that are being paid. The top 2 were each paid $305,000, which you can see over on the right. And then the last officer was paid $99,500. And I'm going to scroll down just a bit for a second. you can see the total here is $709,500, and that's what was reported on page 1 of the tax return. Now, what's important to notice here is this schedule provides for the percentage of the common stock that's owned, right? So we have officer, we'll call them officer number 1, number 2, and number 3, because we redacted their names. But officer number 1 owns 37.5% of this company. That person was paid $305,000. Officer number 2 owns 32.5% and was paid the same $305,000. So there's no correlation between ownership percentage and the amount of compensation that you're paid. What this is actually supposed to represent in the IRS's eyes is what's considered to be reasonable compensation or market compensation. And we're asked to do this for accountants a lot, to go through what their specific roles are in this particular company, do some research, because we do it for our valuations, and come up with what amount of compensation would that person be receiving out in the market.
Right, and this number here, the 305,000, one of the officers on the personal return, when we do that, you'll see that matches. That's gonna flow through right to his wages.
Right, and this, for these numbers, the backup that you're going to want, other than this particular schedule, are the W-2s themselves, because each of these compensation amounts are reported to the officers or the shareholders, not through a Schedule K-1, but through just an ordinary W-2. So that's, if you want to support that 305,000, you ask for a W-2.
And guys, just a little note, if you read above, complete Form 1125E only if receipts are $500,000 or more. So if it's a very small company, they don't have to fill this out. Okay, here are just some of the statements. Lou can take you through some of it quick. We don't want to spend all day on it, but
so as we were going through the first set of those main schedules that Dave went through, there were references to statement 1 and statement 2. So these are what are going to provide the detail for each of those statements. So throughout the main schedules, they'll give you sort of a one-liner. Page 1 has other deductions that totaled $1,850,000. This statement 2 is going to give you the breakout for that. So, we use this, in order to sort of, we call it the 90-10 rule. What's the most important of the business expenses to go through? So, just eyeballing this, professional fees at almost $600,000. That's more material than the bank charges at $1,900. So, this helps us to kind of zone in on what we want to look at on the general ledgers.
Right, meals, travel, those are always important ones, auto expense also. And here at the bottom is just another, showing you the 812 charitable contributions on K1.
Yeah, and what I want to zoom ahead to is statement 5, which Dave just brought up. So statement 5 is the detail to other current assets on Schedule L. So as you can see, it kind of gives you the roadmap right across the top of this particular statement. It's going to tell you this is the detail for Schedule L and very specifically other current assets. Now, if you notice here, this has a very large asset, securities owned at market value at $55 million that declined all the way to $42 million. There's a 2022 tax return, and the S&P 500 was down like 26% that year. So that actually makes a lot of sense. Nonetheless, when we see something like this, we want to make sure that we have the brokerage account that's going to support, the market values of the securities. And we always want to make sure that it's marked to market, because if it's just something that's at cost, that's not reflective of fair market value.
And this one actually tells us it's a market value. Most of them don't.
This is a very detailed tax return.
Okay, so we talked about the other investments. It happens to be in a small little LLC. Probably should have redacted that, but that's okay.
Yeah, and what's interesting is, so this was not reported on Schedule B that David showed you earlier. So right. What we do know and what we can tell just from this tax return alone is that this company the company, not the shareholders directly, it's the company has an investment in this Fluent LLC, and it has to be less than a 20% investment because it wasn't reported on Schedule B earlier on.
Or it should be at least.
Correct.
And then here, statement seven's other assets and just, moving on, you have current liabilities. So the inventory short, it's a brokerage dealer, so it's shorting stocks. Accrued expenses, all those things that we see. There's a margin balance. And then this is just, the bottom is just an analysis of the retained earnings for the books. Starting at, this happens to, it matches, so this, what we saw earlier, the beginning retained earnings, the loss for books, and the ending retained earnings. And then I think that's pretty much it for the schedules we need to go through.
Yeah, let's go ahead to the Schedule K1s.
Yep, we're gonna do that. Here is, this one, which we also for the M3, which we don't see often. It gives a difference between income statement and tax return. There's no difference here, but that's just something that would be helpful for us to reconcile it if there was a difference.
Yep. So I'll quickly go through a Schedule K1 and the important information that you want to look for. So it's redacted, so it's a little difficult for you to see, but if you look at box B here, so that's the corporation's name. So that's sort of low-hanging fruit. You want to make sure this is a K1 for the particular corporation that we're looking at. A couple of boxes down, the total number of shares. So we mentioned earlier that S corporations, they issue shares of, it's always one block of shares, always common stock. So in this case, this particular entity has 100 outstanding shares, which means if this shareholder, skipping down a few more boxes, they're allocated 37.5%. That is their ownership percentage, which means that they must own 37.5 of the 100 shares. So this is just sort of arithmetic, and it's very easy to follow. And then, of course, box F is going to have that shareholder's name. You always want to make sure that you're looking at the right K1. A little unique for Schedule K1s, they don't usually give you this level of information, but this particular K1 actually lets us know that this shareholder has loaned the company $1,250,000. That's good information to know if you're representing a non-titled spouse and you want to know if the titled spouse has loaned the company a disproportionate share of money relative to its shareholder counterparts.
You'll also want to check their net worth, see if that is in fact an asset on the net worth.
Exactly. Scrolling back to the top. So here we have box 1, ordinary business income of $111,104. Where does that come from? If you remember, page 1 of the tax return had that income of $296,277. This particular shareholder owns 37.5%. So the arithmetic on that is 296,000 times 37.5% will result in $111,104. That gets reported right in box 1. Box 1 is going to translate to the personal tax return, specifically Schedule E. And by the way, just a quick plug, on April 3rd, Dave and I are going to be giving a similar webinar, but on the other side of the coin here, on the personal tax return side. So we're going to show you where all these numbers end up translating to. And that's going to be important. As I mentioned earlier, interest income and ordinary dividends, where do they end up on the personal tax returns? Exactly where you would otherwise report that information, which would be Schedule B for those items. Similarly, net short-term capital gains and net long-term capital gains, you would report that on Schedule D of the Form 1040. So we'll get into that, in our next April 3rd webinar. The last and most important item that I'd like you to turn your attention to is 16, which is items affecting shareholder basis. Here, there were no distributions to shareholders. So this section is blank. If there were distributions to shareholders, you would see a code D here with the amount of the distributions. And the distributions don't necessarily have to match the ordinary business income, as we mentioned earlier. It could be higher, it could be lower, it could be the same. But if the business decides that it needs to hold on to cash for future growth, it's very common to see that the business income is greater than the distributions because they're keeping cash in the business. Conversely, if in prior years they haven't made those distributions and they find themselves with a surplus of cash, you can find that the distributions are greater than the reported income for that particular year.
Right, and that's kind of the difference between cash flow and income, which was the subject of our last webinar done by Mrs. Kramer and Mr. Gibraltar.
That's
So
right.
Jeff and Maida did that one. And by the way, box 12A, the 304,610, that's just the charitable contributions. That'll eventually hit your Schedule A on the personal return. And here's just the next one, who owned 32.5%, and you can see their loans were 750,000. And if you do the math, all this just keeps working out into, works out based on the numbers above. So there, again, we said there was 7 of them. That's going to be the 7th one. So we're now on to partnership tax returns. So partnership tax return, Form 1065, LLCs and partnerships file on the same form, okay? So, you hear us say members all the time. If it, that's a partnership tax return. So it's very, very similar to a 1120S. So we're not going to go into as much detail, but just some of the differences. Page 1 tells you the business activity and the product or service as opposed to page 2. Here's the business code still on page 1, just I think it's a different letter, okay? And the date the business started is still there, but there's no election or anything for a partnership. So it should be the day that the partnership starts. Here you have the total assets, that's the same. The accounting method again, which we're going to go back into, tells you how many owners there were, 5 here, members. So there should be 5 K1s again, okay? And again, the basically the same thing, your gross receipts. Here, there's no cost of goods sold, but it would be there again. So the gross profit, then if there's any other income that goes there, and then you have your total income, your essentially your sales. So what's going to be different here on the second part of this? Instead of the owner's compensation being the first line, here we have guaranteed payments to partners, which is the second line or line 10 here. So that's essentially the owner's compensation if they get paid a W-2, or sometimes we see it as like health insurance paid on their behalf or other things paid on their behalf. And the rest of these are very similar. You get your total deductions, line 21, your ordinary business income again. Again, this flows through, it's a pass-through, so it's going to flow through to the personal return, so there's no tax here. And at the bottom of the page, you'll have all of the information you need for the accountant, so you can get the information. Page 2, this is again, your reconciliation, your Schedule K to K1. Here we have, with the actually interest income of $77. I think at the bottom here, we actually have distributions on this one of 70,000, and Lou's going to show you exactly how that translates to the K1. And then you have again the balance sheet, beginning of the year, end of the year. You have your M1. In this case, it's filled out. Go figure. And then you have your M2, which is essentially your capital account for the entire business, not just one owner. But again, it shows you the minus 611, which matches the beginning of the year capital account. You had income of 87,000. You had distributions of 70. So that translates to 16,000 and change of your capital account at the end of the year. And then what other types of information does it tell you? It's a domestic limited liability company. There's no foreign partners. You can go through these again here, no foreign partners. No one owned, someone owned more than 50%. So you can look for that on the tax return. And again, it doesn't own any large portion of any business. So those are the important ones there. Here you have the individuals or states owning 50% or more. This is the maximum owned. So we're gonna see sometimes, because it changes hands sometimes, that's gonna actually could be more than 100% because it's the maximum percentage owned in profit, loss, or capital. And in a partnership, those don't have to match. In an S corp, they do, okay, and also in an S corp, distributions have to be in the same proportion, where in a partnership, they do not have to be in proportion to distributions.
Correct.
So sometimes you'll see a disproportionate proportion distribution in a partnership. You're not going to see that in an S corp. So it's a little thing, little things you can look for that we don't often talk about. Here's an example of a depreciation or amortization report. This happens to be amortization because they're organizational costs. So it just tells you, you see this with fixed assets. Sometimes they can be very long. They have equipment, they have buildings, they have furniture and fixtures, and they, some of them go back. They have things that are, 18, 20 years old that are fully depreciated. And then they have the new stuff. And then they have the Section 179 expense. This is what you can, you could take the accelerated depreciations. So those are all things you may want to look for. And if you don't get one of these and there is fixed assets, it's something you want to ask for.
Yeah, and this schedule, although very simplistic in what's presented here, it's important to review this, because if you have a company that is very equipment intensive, or if you have a real estate holding entity and you have buildings, you have to know what the company owns, right? You have to know what equipment it owns, what property it owns. So if you go to the depreciation and amortization schedule, it'll show you exactly what that company owns in terms of capital assets or fixed assets, when they acquired it, and then what is the value that's being reflected on the balance sheet today. So as you can see, look at, well, these are organizational costs, so these are more intangible assets, but as you can see, the total cost basis in the middle of the page there is $4,349. All the way over on the right, the ending accumulated depreciation is $4,349. So all of the cost is being wiped out for these assets on the balance sheet.
If you look them starting 2002 and 2003, and they have lives of 60 M, which is months. So basically, I don't know why they didn't do 5 years, but they wrote 60 months. Here are just, again, which we saw last time. These are the subschedules. Tells you exactly what the schedule is. So, we can just move on because it's the same thing that we saw in the S corp. This is a partner's capital account summary. So it tells you the partner number. There's no partner one anymore, which means that partner is probably sold or deceased. Okay, tells you that the individual beginning capital, the individual income, the individual withdrawals. You can see it's actually seems to be in proportion here, although maybe not, because it's in proportion. And then the ending capital. And then here's an example of the K1. Lou will talk about this a little, and the differences between the S corp K1 and the partnership K1.
So most of the information on the top left is going to be the same. It's the partnership name, it's the name of the partner. They give some specific information like social security numbers and employer identification numbers. Where it gets a little bit different is in terms of the ownership percentages here. So it's stated in 3 buckets, whereas on the S corp, it's just what percentage of the stock do you own, or of the outstanding shares do you own. Here, it presents a profit percentage, a loss percentage, and a capital percentage. And it's the same for this particular company, but it doesn't necessarily have to be. One partner could have an arrangement where they're getting 30% of the profit, but only have to take on 20% of the loss because they have a rosy deal with the partnership.
Or vice versa, they could have a higher loss percentage because they may have something on their personal tax return where they can take a loss and someone else can't.
Absolutely. So in this case, it's the same across the board. You can usually find this information, within the operating agreement or the LLC agreement, and it should set forth how the profits and the losses are allocated, not distributed, but allocated. It's very specific in the agreements. With the S corporations, they did not present a capital account. Doesn't mean that there isn't one that's sort of being maintained in the background so that you know what that shareholder's basis is. But it's not explicitly reported with on the K1.
And it's actually technically up to the shareholder in an S corp to keep track of their basis, as opposed to here, it's the partnership's responsibility to do it.
That's correct. So as you can see, the partner's capital account is very similar to if you look at like a bank statement, right? You have your beginning balance, your ending balance, and in between you have your withdrawals. You have your contributions. So contributions would increase the capital account. That's money in. Withdrawals and distributions would decrease the capital account. That's money out. And then right in the middle, you have this particular partner's allocation based on the profit or loss, whichever the partnership had, allocation of that profit or loss. So in this particular case, this partner had $32,000 of income that was allocated to him or her, and they took distributions of $26,250.
And those distributions you can see appear in 19A here, as opposed to 16D on an S corp.
Right,
Okay, well,
16D, 19A, those are the codes and subcodes that you want to look for over on the right side here in order to identify distributions. The top part of this right side, it's not so different from the S corp insofar as you'll see this particular partner's allocation of the ordinary business income, as well as, again, interest income, ordinary dividends. The only difference here is you'll see the reporting of guaranteed payments right on the K1. And that's because guaranteed payments are reported through Schedule K1. Remember, we talked about on S corporations, if a partner or if a shareholder was receiving any compensation, they would get a W-2, and it would get reported on page 1 of their personal tax return under W-2s and that section. However, for LLCs and partnerships, the guaranteed payments are a function of the Schedule K1, which would also get reported on Schedule E of the personal tax return.
okay, so these are just the other people's K1s, and that's it for the partnership tax return. So Lou's going to talk now about the different methods of accounting quickly.
Yes, and I will keep this brief as we are running out of time. So we talked about accounting methods that are reported on the business tax returns. The cash and accrual methods, which are Roman numerals 1 and 2, are the most commonly occurring accounting methods. We did give you guys a few others here. So number 3 is the completed contracts percentage of completion method. That's very specific for construction companies. And the way that works is, you have what the companies do is they estimate what they think the total income will be from a job. And then they'll also estimate what they think the expenses, direct expenses for that job are going to be. And if in a given year they complete, say, 20% of the job or the contract, they'll report 20% of the estimated income and 20% of the estimated expenses. When the job is complete, they do what's sort of like a true up. And if they underestimated or overestimated, they'll have to report the balance within that year to bring them to the full cost and the full income of the job. So that's very specific on construction companies. The second is what's called a hybrid method. So that's going to be, a combination of cash and accruals. So companies are allowed to do that. They're allowed to use a combination of the cash and accrual, whichever best reports, that particular income, expense, asset, or liability item. Where it gets a little hairy with the hybrid method is that each particular item, you have to be explicit as to what basis it's being reported under, whether it's cash basis or accrual basis. So it makes it very uncommon because there's a lot of legwork that goes into it. The last method is the tax accounting method. So this is basically, it's a deviation from GAAP. So generally accepted accounting principles, which is GAAP, financial statements are required to be reported under GAAP, but tax returns are not. So the IRS has its own sort of rule. So that's when you see tax depreciation versus book depreciation, because tax depreciation is picking up, it could be Section 179 accelerated depreciation, and that's okay for the IRS. But for GAAP purposes and financial statement reporting purposes, not okay. And therefore, you'll never see a tax basis of accounting on an audited financial statement, maybe on a reviewed financial statement. And
So just so you know, the cash and the accrual are the ones we see most of the time. All right, those are the ones, and that's what we're going to teach you a little bit about those right now.
so just a quick illustrative example. So let's say you have a contract for $100,000, okay? The service is provided for that contract, an invoice is issued for that contract on December 25th, 2024. But the client doesn't actually pay that invoice until January 3rd, 2025. Under the accrual basis of accounting, that $100,000 is going to be reported in 2024. And the reason why it's reported in 2024 is because that's when the work was done. That's when it was earned. So under the accrual basis, that's what we look for. When was the work done? When was it earned? However, under the cash basis, think about, in terms of cash basis, think about real dollars exchanging hands. So the $100,000 is going to be reported in 2025 because that's when that amount was actually received by the company. Okay, now let's look at the other side of the coin. Let's say you have an expense and it's a $50,000 payment to an outside consultant. And that outside consultant did the work for you on December 25th, 2024, Christmas. The company, however, doesn't pay that invoice. The consultant's invoice doesn't get paid till the next year, January 3rd, 2025. So when are you going to report the $50,000 expense? So under the accrual basis, the expense is going to be reported in 2024. And that's because that's when this company incurred the expense. However, because it wasn't paid till 2025, under the cash basis of accounting method, it's not going to be reported until 2025. So the most common terms, which we learned in accounting school for these accounting methods, is accrual basis, you think earned and incurred. And with cash basis, you think received and paid. And that's the distinction between accrual basis and cash basis. So when you're looking through a tax return and you're trying to understand, well, this tax return says that, my client made, $1 million, but I know that he only received $600,000. It could be because you're looking at accrual basis income, and maybe he has a large receivable of $400,000 amongst a multitude of other reasons, but that could be one of them. And that's now you have the tools to look to that and say, oh, okay, I understand. He didn't report the other 400,000 because it wasn't received yet.
All right, Sammy, any questions?
Yes, we have one question.
Okay,
If shareholders take no distributions in S Corp, but the company has a profit, what is each shareholder's taxable income beyond the salary they take?
the percentage of the profit. Distributions are not taxable in an S Corp or on a partnership. Okay, unless the basis exceeds, possibly unless the basis is exceeded by the distributions.
Right. So I guess the high point there is that the distributions from an S Corp don't affect the net income. The net income is the net income after cost of goods sold, after operating expenses. The distributions don't affect that.
And they're not taxable. Any other questions?
Nope.
All right, well, guys, we want to thank you for joining us today. If you have any questions, you can always feel free to either call or email Lou and myself. as the NCAA tournament is coming up in a week and a half,
Oh, geez.
we want to give you a little tips for if you're filling out your pools. So tip number 1, always take a 12 over a 5. It happens almost every year.
One upset.
Yep, there's always one of them. Tip number 2 would be the teams that have those playing games. The 11s seem to have some kind of, extra umph going, they played a game. So those are, that we see 11s beating 6s more often now that the playing games are. And tip number 3, which kills me to say, always bet on Tom Izzo in March. So hopefully that'll help you fill out your pools. If you have any questions on that, Lou is definitely the expert.
Thank you for sticking through that. Once again, April 3rd, we'll be doing the other side of this, which is the personal tax return, and we'll show everyone how the business tax returns translate to the personal tax
And
returns.
hopefully you'll be able to join us again then. Have a good day, everyone.
Bye now.